Good morning. Key metrics every CRE investor must know. So, when it comes to commercial real estate investing, numbers really tell the whole story. Whether you're buying, selling, or refinancing, understanding the key performance indicators, or KPIs, behind your asset's value can make or break your deal. And here are the most common, important metrics every savvy investor should master. This one's kind of a no brainer, but net operating income or NOI. And that definition there is income after all operating expenses, but before debt service and taxes. So, why does that matter? Well, NOI determines a property's profitability and is the foundation for calculating cap rates and value. Number two, capitalization rate, cap rate. This is where it's commonly known. But the definition is the ratio of NOI to the property's purchase price or its value. The formula there is cap rate equals NOI divided by purchase price or value. And the investor tip here is you can use cap rates to similar properties in a market, and a lower cap rate often signals higher demand or perceived stability when you're comparing apples to apples. This is the most important one, I think, though, cash on cash return. Definition, it measures the annual return on the cash that you've actually invested into the deal. So the formula is the annual pre-tax cash flow divided by the total cash you invested in the purchase. Pro Insight, this is the go-to metric for investors using leverage. It shows what your money is really earning. Internal rate of return, or IRR, is another big one. And that definition is the projected annualized return over the holding period. So why it matters. IRR accounts for time value of money, critical for comparing long-term investments. Number five is your debt service coverage ratio. So that definition is NOI divided by your annual debt service, which you pay for the loan. And the investor tip there is lenders typically want a DSCR of 125 or higher. And it shows the property generates enough cash flow to cover debt payments comfortably. Number six is loan to value ratio, or LTV. The definition is the loan amount divided by the property's appraised value. And why does it matter? Well, LTV determines leverage and impacts your borrowing terms. And lower LTVs generally get better rates, is the concept. These are also very important. Vacancy rate and occupancy rate. So the definition is that the percentage of rentable space that's unoccupied or occupied versus the total rentable feet. And the insight there is investors can use this to gauge market demand and property performance. High vacancy often means an overbuilt market. Your expense ratio. So that definition is the operating expenses divided by the effective gross income. And there's the tip here is that efficient operations generally have an expense ratio below 40% depending on the property type. 60-40 is the go-to rule of thumb. 9, your break-even ratio. So that definition is operating expenses plus debt service divided by gross operating income. So why that matters, this shows how much vacancy the property can handle before it starts losing money. And number 10, your rent growth rate. And that definition is the percentage increase in rental income year over year. And why does that matter? Well, consistent rent growth signals a healthy market and boosts long-term returns. And if rent's growing and you're not increasing your rents, that's something to consider. Now, with all that I said, here is your final takeaway. Commercial real estate is a numbers game. Those who understand the math win. By tracking these 10 key metrics, investors can identify value, manage risk, and make data-driven decisions that maximize your personal return. That's it for the day. Hope you have a good one.